Today, I'm diving into something that trips up even seasoned investors: taxes. I'll share 3 real-life stories from my own personal investing experiences, where trying to save because of taxes, delay paying taxes, has costed me a lot. And I want to share those lessons with you. Don't worry, I'm not going to tell you anything illegal or shady, just honest, unfiltered financial experiences. Hey everyone, welcome back to another episode of Finance with N. If you're new here, thank you for joining. And if you've been watching from the beginning, thank you for your loyalty. You're the reason I keep doing this. Lesson 1, selling Tesla too late. My first story is about timing and when to sell. I'd been buying Tesla stock for quite a while, and by the middle of 2024, I'd collected quite a bit of Tesla shares. My average buying price was around $230 a share. And then what happened? Towards the mid to late of 2024, the stock was surging. My investment had doubled, and I was thinking about selling. The price of Tesla, one share of Tesla, was almost $500 a share. That was a lot of profit for me to take. But I hesitated. Why? In my country, where I live, capital gains are taxed at 25%. And so I hesitated. I thought, why don't I wait till January of 2025 and then sell? The stock price would probably go higher, I'd have a higher profit, and I could then put my capital gains in my 2025 return, which I'd have to pay in 2026. Guess what? Wrong move. The stock dropped. It literally went down more than 50%. Not only did I lose my profits, I went into a loss. Paying taxes was not my biggest problem anymore. What did I learn from this? Taxes, tax policy should not paralyze my investment decision. If the profit is good, I should be happy, I should take it, and I should pay the taxes. After all, 75% of something is way better than 100% of nothing, isn't it? Now let me share with you the second lesson I learned when it comes to dealing with taxes and investments through another story. While working in Europe, I had the opportunity to reduce my insanely high marginal tax rate of 61% by investing in a voluntary pension scheme. On paper, it made sense, but in practice, there were quite a few caveats. First of all, I had to pay a load of 1%. That means every 100 euros or $100 that I invested into this voluntary pension fund came with 1 euro as a cost, which meant that only 99 euros would get invested. Moreover, the management fee or the expense ratio was quite high. And whether I made a profit or a loss, so that is whether the fund did well or it did poorly that year, the fund house would take quite a bit in terms of expenses. What was worse? Well, I couldn't access my money till retirement. And it feels that each year, retirement gets further and further away because governments are increasing retirement ages in a lot of countries. Worse, I found out that a lot of the fund's investments were quite speculative. So along with mediocre returns came quite high risk. Nevertheless, I compared the returns to a broad S&P 500 ETF. The S&P 500 ETF comes with pretty low expense ratios. You can get an S&P 500 ETF for just a 0.03% expense ratio. Even after paying a ridiculous marginal tax rate of 61%, it still made more sense to invest in an S&P 500 kind of ETF than to put it in a voluntary pension scheme in my country. Kind of weird, but that's the reality. What's even better is the S&P 500 ETF is something I could withdraw at any given point in time. And in my country, if I keep an investment for 15 years, it is completely tax-free from capital gains. So then I ask myself, why would I invest in a voluntary pension scheme? So what's the lesson I learned from this? Don't just jump into some sort of a scheme because of a tax break. Read the fine print. Understand the reality. Sometimes on paper, something may look really good, but in reality, in practice, it may not. A lock-in period of 40 years, let's say from the time one invests, if one is a 25-year-old, is massive. And one doesn't really fully understand what it means till later on in life. I realize I don't want that for myself. Do you want to learn more about S&P 500 ETFs? I'm putting a link to another video I made on this and my view on S&P 500 ETFs and what I like about it. Please do watch it. The third lesson I learned was when I was living in India several years back and I was investing in tax-saving or tax-free mutual funds. When I lived in India several years back, there was a scheme where if I invested in tax-free or tax-saving mutual funds, I would save around 30% in tax. Why? Because my marginal tax rate was about 30% back then. I thought, hey, this is great. I can pay less taxes if I invest in these funds, and my investment's going to grow. Well, not precisely. Why? Well, first of all, when investing in a tax saving scheme in India or a tax-free mutual fund, there's a 3-year lock-in period. Well, it's better than, let's say, the voluntary pension scheme in Europe, but there's a catch. What happened was I invested in one of these so-called tax-saving schemes or mutual funds, and in the middle of it, the fund manager changed. I don't know, maybe the fund manager left the company or something. But after the fund manager changed, the performance of the fund was horrible. It did really bad. And because of the lock-in period, I didn't take my money out. If I took my money out, I'd have to pay the tax back. But guess what? It would have been much smarter for me to take my money out and pay the tax, because I lost more money just staying in the fund. What I noticed is over the 3-year period, these funds performed worse than non-tax saving funds. There are roughly about 30 so-called tax saving mutual funds, but there are thousands of non-tax saving funds. Why would I restrict myself, have less flexibility just to try and save 30% on taxes with a smaller set of funds, when the truth is I could have a much larger pool of funds to choose from, not worry so much about the tax saving, but in the long run I'd still make enough returns to more than make up for the higher taxes I'd pay on the income. I thought to myself, makes sense, right? So the lesson I learned was, don't let tax-free or tax saving distract me. Sometimes paying the tax and investing smarter pays off in the long run. It will give me more freedom and higher returns. All 3 stories have a common thread. I tried to be tax smart, but I compromised on flexibility, on liquidity, and performance. I also ended up paying higher costs. So here's the bottom line. Don't let tax saving schemes dictate your investment decisions. Focus on solid strategies, good returns, and make smart decisions. If you feel that you've made a profit at the right time and you want to get out, get out. That's what I should have done with Tesla, for instance. Also, please remember, every country has its own tax laws, so please do consult a tax advisor in your country. This video is meant purely for me to share my personal experiences with you. It is meant for educational entertainment purposes. It is not meant to be tax advice. Also, if you like this video, please do hit the subscribe button. It'll make sure that you get notifications right away when I publish a video. Have you invested in any tax saving scheme and saved any money? Or has it burnt your fingers? Please do write it in the comments below. Let's build and grow our community and share positive information.